If you asked just the average person on the street for an infallible investment strategy, they'd probably point to a brick and mortar flat in London.
Oh, absolutely.
It's the ultimate safe bet, right?
Yeah.
Because prices only go up. But we're doing a deep dive today into the decline of London's property market. And the data we've gathered paints a picture of a market that isn't just cooling off, it's fracturing entirely.
Yeah, and decline feels like a really soft word for what some sellers are actually facing right now.
Right.
We aren't just talking about a little dip in growth.
Right.
We're looking at what some analysts are calling eye-watering losses.
And that's the part that really jumped out at me. I mean, you and I are so used to headlines about affordability crises and how nobody can buy a home, but the recent numbers highlight flat owners seeing losses of up to 34%.
It's massive.
That's hundreds of thousands of pounds completely wiped out. How is that even possible in a city with such a chronic housing shortage?
Well, that is where the nuance kicks in. You really have to stop thinking of London as a single, unified property market.
It's actually a two-speed market now.
A two-speed market. It feels like a tale of two totally different economic realities.
Exactly. So if you bought a prime flat in, say, a postcode that's historically synonymous with wealth, you might be underwater right now. Demand there has contracted sharply. But, and this is the really interesting twist, if you look at the traditionally affordable boroughs, the graph looks completely different.
Because that's where the buyers actually are.
Right.
They've been priced out of the center and essentially pushed outward. The data we reviewed specifically mentioned places like Havering, Waltham Forest, and Lewisham.
Exactly. While someone in Chelsea might be aggressively slashing their asking price just to get a viewing, average house prices in those outer boroughs actually hit all-time highs last autumn. So the crash is happening, but it's highly localized.
It depends entirely on whether you're holding a luxury asset or a baseline necessity.
Spot on. Well, speaking of assets people usually clamor for, what on earth is going on with new builds? You walk around London, you see cranes absolutely everywhere. You assume business is booming. But the reports describe new builds as increasingly unloved.
It's a supply and demand mismatch, but definitely not the one you'd expect. On the supply side, construction has basically ground to a halt in some areas. The developers are citing onerous red tape, but there's also a major policy angle here. The mayor has a mandate requiring that over a third of new housing must be sold at a discount.
Which sounds fantastic for social equity. But I assume developers are arguing that it eats right into their margins.
Precisely. They claim it makes the projects completely unviable, but honestly, the bigger issue is actually on the buyer's side. It's the financial structure of buying a new build. It's essentially the new car syndrome applied to real estate.
Oh, meaning you drive it off the lot, or in this case, pick up the keys, and the value just drops instantly?
That is the exact risk. New builds carry a significant newness premium compared to the secondhand market. If you have to sell that flat within the first few years, that premium just evaporates.
Because you're suddenly competing with older, cheaper stock right next door.
Exactly. Savvy buyers have figured this out, and they are actively avoiding new builds to dodge that guaranteed initial depreciation.
So to recap, we have a market where prime assets are losing value, new stock is a depreciation trap, and the only real growth is in the budget sector. It's brewing into a massive political headache.
It really disrupts the basic social contract. Historically, high prices made renters angry but kept the owners happy. Now, you have renters furious because they're entirely excluded, and owners furious because the market isn't rewarding them. It's a lose-lose.
But I want to push back on that reward aspect for a second, because there was one statistic in our research that completely reframed this whole topic for me. We need to talk about inflation.
Yes, this is the real aha moment of our deep dive today. If you look at nominal prices, just the raw number on the price tag, houses across the UK have roughly doubled since 2003.
Which is the number everyone cites at dinner parties. You know, my house doubled in value.
On paper, yes. But the purchasing power of the pound has almost halved in that exact same period. So when you actually adjust for inflation, the real value of the average UK property is basically flat compared to 20 years ago.
That is staggering. So the asset hasn't actually grown in value.
In real terms, barely at all. It has mostly just acted as a hedge, keeping pace with currency devaluation. It completely challenges the cultural dogma that property is this magical wealth-generating engine.
It's less of an engine and more of a life raft.
A very expensive life raft.
So looking ahead, industry forecasts are predicting a property value rise of just over 1% for London next year.
Which critically lags behind the rest of the UK. And if inflation is higher than 1%, that means another year of falling prices in real terms.
It really forces you to ask a difficult question. If the real value of a home hasn't actually moved in over 2 decades, is the property ladder actually a ladder, or have we just been running on a treadmill this whole time?
That is definitely the question to ask.